Hi guys, a very good morning and welcome to Trading Hour. I'm Pavitra Parekh. With me are Prashant as well as Sumera. It is definitely a down day, but we've seen a solid recovery play out. We did get that gap down start, but if you take a look at what's happened ever since then, we've recovered over 150 points from the lows right now. In fact, as we speak, the Nifty Bank has also moved into the green. So we've definitely seen quite a recovery come through, and this at a time when the rest of the Asian markets are still seeing sharp cuts. So if you take a look at the Hang Seng markets, if you take a look at Nikkei, all of them are sharply lower. You have the rates on your screen right now. So Hang Seng and Nikkei both down over 2.5%. Kospi is down 1.3%. And in that context, our markets have seen a big recovery come through. On the downside, of course, it is the IT pack, which, continues to lead the decline. So the IT index in itself is down over 3%, and some of the larger stocks are up on your screen. And on the stocks which are managing to hold up, it is some of the PSU stocks, so the likes of NTPC, ONGC, as well as Power Grid. These are a few of the stocks which are managing to hold up in the green. But Sumera, considering the kind of handover that we got from the global markets, this is looking not too bad at all.
Not too bad. In fact, I'm dressed for it. Okay, but let's start with the big data point that's driving the market today, which is the U.S. inflation reading for August. Inflation in the U.S. was higher than expected, even as gas prices cooled. The consumer price index increased 0.1% over the previous month and 8.3% year-on-year. Increases in food, shelter prices have offset the decline in gas prices, though. CNBC's Steve Leesman gets in the highlights.
Yeah, the August inflation number making a huge disappointment for markets, looking for a peak inflation and for a Fed to do fewer rate hikes, all of that going the wrong way. I'm not going to read you all these numbers. All you got to do is look at the chart. It shows every number came in above expectations. The most important one, that core CPI, doubled the expectation. That's the one the markets and the Fed hoped would have cooled more and would have led to lower policy. Instead, how did we get here? In gasoline, it behaved as expected, down 10.6%. But food coming in hot at 0.8. Housing, that's a third of the index, up 0.7. And apparel as well. We're not seeing the inventory, the bloated inventories and the pass along in lower prices in the apparel or other goods sectors. By the year end, the market now sees the Fed over 4%, and the peak funds rate has risen to an expectation of 4.35 now. That just ticked up again, up from the 4% before the meeting. And the market now pricing in a 33% chance of a 100 basis point rate hike next week. I think it's overstating the case, but it's a sign of how concerning this market sees the inflation report today.
All right, those are the broad numbers that came through on the CPI inflation. But Prashant is also standing by at the big wall to put all of this into perspective for us. Prashant.
Well, thanks very much for that. So just a couple of things, right? So Steve earlier put out the numbers in granular detail, what moved and the components, etc. The basic takeaway from all of that is that services inflation, which is much harder to rid of, is high, is stubbornly high, and goods inflation is also is not seeing any big step down or anything of that sort. There are two implications of what we've seen in terms of this US CPI, which is beaten expectations. One, what it's done is it's firmly and decisively put an end to the equity relief rally that we were starting to see in the US and the decline in the dollar, which many were anticipating. So that is one. Second, it's also in a way put to bed some expectations of a soft landing, optimism that the economy in the US will just be fine. It will not be too hot, too cold. The Fed will not have to do too much because inflation will come under control, and it'll all be back to a Goldilocks kind of scenario. The inflation number kind of puts to bed that kind of optimism as well. What from here? Remember, the Fed is in a blackout period, so we will not have commentary from Fed officials. And we've had plenty of that to go around before the Fed went into the blackout. A reportage basically from publications like the Wall Street Journal, which markets watch very closely in terms of what the Fed's thinking is, what they may do in September, and further plans beyond that as well, I think will be closely watched out for. 75 basis points is still priced in as far as September is concerned, but now you can't rule out 100 as well. So that's another one. The cumulative market pricing of what the Fed will do, the cumulative pricing for September, November and December in one single day jumped by 28 basis points. I mean, that is very large. And again, market pricing of the Fed funds rate by the end of the year now stands at 4.2%. Remember, the Fed dot plot is still at 3.4% by the end of for the end of December, that most certainly will move higher. What this has done, all of the action overnight has done, is that it's also moved market pricing of what other central banks, like the Bank of England, like the Bank of Canada, like the Reserve Bank of Australia, pricing for these central banks also higher. You know, the Fed and what it's doing to control inflation at home in the US is likely to put pressure on other central banks around the world, perhaps including the RBI. The Reserve Bank of India, by the way, meets a little later in the month. Fed meets on the 21st, and then later, a few days after, we get the decision from the Reserve Bank of India as well. So this does arguably put pressure on other central banks as well. The dollar is an important channel through which, you know, emerging market flows are impacted, and the dollar saw a very large move. The dollar index rose 1.5%. It's the single largest one-day move since March of 2020. Let's just have the Nifty up for a quick bit. You know, we've been talking about this nice, strong bounce back that we have seen, and it is a very nice, strong bounce back from the day's low, right? And people have market participants have gotten habituated to the fact that, you know, the market will sell off, and irrespective of what the globe is doing, the market will be just fine. It has been fine. I just want to say two things. One, what we are seeing in India is everyday large, chunky, 2,000 crore kind of inflows. That could be a function of, and we've explained this in detail, dedicated allocation for India as other emerging markets and benchmarks, like the MSCI emerging market, not doing well at all. I mean, you know, 75% of the MSCI emerging market constituents are having trouble. India is not. I mean, arguably, it's the strongest and the fastest growing economy. So we might be getting chunky inflows. But the second point is, if you were expecting support, it's not that the market here has needed support from global markets to go higher, but the fact is, if you were expecting support from global markets to continue this rally onwards, I think that kind of disappears after what we've seen as far as inflation numbers last night go. So that's, I mean, you know, my 2 bits. But let's get the expert in. We have Paul Schult of Schult Research joining us right now to take some questions. Paul, of course, is outspoken and fearless. Paul, great to have you with us here on the program. Thanks very much.
Hi, thank you.
It's a pleasure. So what's your reading, Paul, of what we've seen last night as far as the inflation number is concerned? It kind of dashes any hopes that inflation is coming off and it's transitory, and there were many votaries of that even now. Go on.
Yeah, so the last time I was with you guys, I mentioned that there were a lot of different reasons why inflation is going to be sticky on the way down. You know, China is retreating from the world in many ways, and this is going to be a drag on what was previously quite cheap goods and quite cheap labor. And that's happening. And we have, obviously, the Russia-Ukraine situation is still out of hand, and that's also very inflationary. We have a labor force in America that's on the warpath because they've been, they've been living on, $7 minimum wage for 20 years. And so you have a very aggressive labor pool who is sick and tired of not being able to have a wage that allows them to even live in so many major cities. And of course, don't forget that September is notoriously awful month for equities. September into the middle of October is notoriously, when we get crashes and corrections. And so, this is bad data at a bad time.
I remember, Paul, I remember this. You said, we tend to get 40 car pileups. I still remember you said the phrase you used towards the end of the year.
Yeah, that's right. And so people have come back from their vacation. They're looking at the markets. They're digesting everything for what's coming up in the next year, and they're starting to say, okay, this is just not going to be as good as we thought, and so we need out of this. And I think that's just like the same old pattern over and over and over again as people return from vacation. And this is what we see happening right now. That, like you said, I think you put it really well in your intro. We're just not going to have sort of the Goldilocks, scenario. But I don't think 100 basis points is realistic. I think it's going to be between 50 and 75 coming up next week. The problem is that central banks in emerging markets are not going to be as fast. And so guess what they're going to do? They're going to let a lot of the pressure come out of the currency. So I think we're going to see weakness in the Indian currency. I think we're going to see weakness in Southeast Asia. South America. And so I think we're going to see a continuously strong dollar.
Okay, two things. One is with regards to what happens in the U.S. Does the dollar go significantly higher, if you have a view on the dollar, because that's an important channel through which flows and sort of risk on or risk off happens in emerging markets. So the dollar, your view on that, and second, I mean, I don't know if you have a view on India specifically, Paul, because it's you were talking about the currency here, right? We've had a very strong currency. The central bank here is using dollars to protect its level. I mean, 80 to a dollar. But while it's perhaps the best performing emerging market currency year to date, the Indian rupee, the stock market here is just 2 or 3% away from an all-time high. First, will the dollar go significantly higher? And if it does go significantly higher, if that is your view, can EMs, even better performing ones like India, escape that? Your thoughts?
So for the currency, I think that unless your central bank is planning on being more aggressive than the Fed, which I doubt it for almost any emerging market, the chances are having a currency which is going to be weaker rather than stronger. I agree with you. India is a very good proxy and an alternative to China, where the news and the China bashing is just getting worse and worse, by the week. And China's is itself retreating and is being chased out of much of the international monetary system by a very aggressive policy by the U.S. And so on the equity side, this explains a lot of it.
Okay.
Brazil is a disaster.
All right. I think we are having some difficulty with that line with Paul. I'll just wait at least half a minute. Okay, I think Paul's link is back. Paul, go on. Sorry, we lost you there, but go on.
Yeah, sorry. I was going to say that India's, again, you look at the BRICS, right? South Africa is sort of a disaster. Russia's a catastrophe with this defeat last weekend. Brazil is a disaster with a very uncertain election outcome. And China is increasingly being chased away from international markets and is itself retreating. So India is a decent option here in terms of what used to be called BRICS.
So it's a peculiar position then, right? The global macros will remain very tough, but if you are investing in a market like India, actually not a market like India, but India, because there is only one India, as you described it as well, within the emerging market bloc, it could be very different. I mean, it doesn't have to pan out like it has historically, which is that dollar strengthening tremendously and U.S. equities down sharply meant much of the same here in India as well. It could be very different this time in that sense.
Well, India's been smart. The RBI is letting the currency take a lot of the hit on inflation rather than aggressively raising interest rates. Indonesia is doing a similar thing. But in terms of the other BRICS, the policy and the responsible behavior of governments and central banks is pretty appalling in Russia, Brazil, South Africa.
Okay, I think
India's kind of last man.
Okay, some issues with the link. Maybe we can put Paul on the phone line if the link is giving us any trouble. We'll try and fix that and come back. By the way, the market here in the meanwhile is, guys, still doing very, very well. I mean, it's recovering even more, just down 120 points. So this seems like a normal kind of a day. I mean, 100-point fall is just what, a little over 0.5% on the index. For an index at about almost 18,000, I mean, this is nothing. And it's so remarkable, Pavitra and Sumera. The markets overnight were down 4-5%. Yeah. And you got a 0.5% cut here.
And the rest of Asia is still looking that bad, right? There's been no respite for the rest of the Asian market. So definitely looks like it's looking quite good in that context.
I think I think Paul is back. Paul, sorry, we lost you there again. Go on.
Yeah, so I was just going to say that from the point of view of policy, from the point of view of looking at where many of these emerging markets fit into the world compared to 3, 5, 7 years ago, Russia has made some terrible, catastrophic decisions with regard to the Ukraine. South Africa is an economic mess, and Brazil is facing a very uncertain election coming up. And so what you're left with are sort of the two men standing, which is sort of India and Indonesia, which are sort of market darlings at the moment, right? So Russia becomes an impossible investment location, and China is increasingly becoming an impossible investment location for most U.S. investors now.
Paul, just one last question, and this is really a bit of a puzzle. Would China continue to hurtle lower on economic parameters, or you think we will see a bit of some change? There's an election in October. President Xi maybe gets a third term. Could we see a dramatic change in approach and management of the economy compared to what we've seen so far this year? The response to COVID as well, and that could be pretty significant if that were to happen. Any thoughts at all?
Well, I think the COVID situation is going to be sort of status quo, but I think the important thing people may be missing in China is the next 5 years is going to be the biggest debt for equity swap in the history of the world, because there's a lot of debt, paper backed up all over the place in China, where you're going to have to reschedule some of this debt, especially in the property sector. And it's vital that China keep the property sector stable. For political reasons. China's not interested in having a crisis. China doesn't do crisis. So they're going to manage this, and that means you're going to have to do a lot of terming out debt, do debt for equity swaps. It's good for the bond market, bad for the equity market. So I'm not a great fan of the equity market for China right now.
All right, Paul, it's a pleasure. It's always great having you with us here, and thank you for joining us on short notice. Appreciate your time here on CNBC-TV18. Thank you.
Hi, welcome back. Here watching Trading Hour. It's time now to focus on the commodity space. As always, Manisha joins in, and today she's going to be putting the focus on zinc. Hi, Manisha. Morning.
Well, I'm looking at the zinc prices because among the base metals, this is an outperformer that we have seen for the last couple of weeks now. Zinc is trading at a 2-week highs right now, and this is after expectations of deeper output cuts in much of Europe, and shortages is what we are looking at, and the inventories have continued to decline as well. If you look at the output cuts, well, Narstar has shut the zinc smelter in Netherlands, and that has been shut since 1st of September. Trafigura also has cut up to nearly 50% of smelting capacity in at least 3 European smelters there. You already have seen output cuts by Obi smelter, this is in France, and then Glencore in Porto-West smelter as well. So the output cuts have been consistent and have seen deeper cuts coming in, especially from Europe. Apart from that, it also is concerns coming in from China, where they are imposing stringent power restrictions across country. So when you look at the zinc output from China as well, for the month of August, we have seen a decline of 2.8% on a month-on-month basis, and this is down by nearly 9% on an year-on-year basis also. Between January and September, Chinese output is estimated to have declined by 2.6%, and there is an interesting report from Citi which has upgraded zinc prices going forward. For the next 3 months, they have put out a target of around 3,200, and for 6 to 12 months, they're expecting the zinc prices to continue to gain up to an average of $3,400 per ton. So good going, especially in this one metal.
Manisha, thanks a lot for getting us that quick update on the zinc prices and the zinc move. But with that, we're going to get into a short break. The market is just around 110 points lower right now, and this recovery has really been led by the banks. So the Nifty Bank is now above 41,000 as well, and it is led by names like indices as well as SBI, which are doing quite well in trade. Indices actually is the top gainer on the Nifty, over 2% higher. So let's get into a short break now. But when we come back, we'll discuss the market technicals. Smitesh Thakkar of earningswaves.com will also join us. Welcome back. You're still tuned into Trading Hour on CNBC-TV18, and let's talk about some individual stocks which are moving around in trade now. Ami Organics is one such which is gaining in trade. Sonal is here to take us through what is taking the stock higher. Sonal.
Good morning. Thanks a lot for that. Well, yes, the stock was doing well in trade yesterday as well. Today as well, in a weak market, it's higher. Now, overnight, we got news that promoters of the company in a block deal have sold some stake in the company. So one of the shareholders has sold 3 lakh shares at 1,037 rupees per share, and the other one as well has also sold 3 lakh shares. That's the promoters, and in total, they have sold 0.8% stake in total equity, around 2% of the promoter's stake as well. Now, despite promoters selling, the stock is not seeing a big decline. That is because the shares have gone in good funds or marquee funds, so to say. Plutus Wealth Management has bought 9.5 lakh shares, and Small Cap World Fund has bought 15.96 lakh shares as far as this particular company is concerned. We spoke to the management and they said that this was the last tranche as far as promoter selling is concerned. They will not be selling any further shares in the future, and this was done primarily because of some personal reasons. As far as fundamentals are concerned, they did say that yes, European energy crisis are impacting industries, but the industries that they cater to have not seen the impact so far. In the near term, the pharma industry that they cater to will not see an impact of energy crisis. They did say that they expect to grow at 20% compounded annual growth rate with margins anywhere between 17 to 19%. So fundamentals remain strong for the company, and that's why no impact of promoters selling the stake in the company.
All right, Sonal, thanks very much for joining in with those details. The banks are having a field day today. So let's focus on one such, IndusInd Bank. There is a Morgan Stanley note that has come out this morning, and Abhishek has the details on that one. Abhishek.
Well, Sumera, as you mentioned, Morgan Stanley has written on IndusInd Bank. They have had management meet, so from there they have given takeaways. They have an overweight rating on the stock with a target price of 1,400 per share. So the key takeaway is that the growth visibility continues to improve, and IndusInd Bank is seeing strong traction on its deposit franchise as well, which is growing at 18 to 20% on a YOY basis, as there are new initiatives being taken to garner deposits. So margins should remain stable is what the management has guided, despite the fact that we are in a rising interest rate scenario. They expect slippages or formation of bad loans to moderate, which could keep credit cost or annualized credit cost, that is provisions for NPA divided by advances ratio, around 1.2% to 1.5%. So lower credit cost always augurs well for healthy return ratios going ahead. Back to you.
All right, Abhishek, thanks a lot for that. So that's IndusInd Bank up 2%, and it is the top gainer on the Nifty. But take a look at the Ambuja cement stock. That one has also moved higher. It's around 4% in the green right now. This on the back of some news flow coming through that they're looking to raise funds. Nigel is here with the details on that one. Nigel.
Well, that's right. The street is buzzing with excitement because Ambuja Cements has put up on the exchanges that they're looking forward to raising some money, and they're going to be meeting for this purpose on September 16th. They have not specified the instrument, but it could be anything from equities to convertible instruments as well. The street is waiting by. What's the quantum of this particular increase? What is the purpose of it? And in fact, who will it be done to? Will it be done to the promoter group, or will it be done to the third party? So clarity is awaited on this front. Remember, it's rather strange when a company is already sitting on a huge amount of cash, that's standalone as well as on a consolidated basis, and they want to go ahead and raise fresh capital. That's giving a sense that they're aggressive, and the street is reading it as they're likely to add capacity. Either it's organic or inorganic growth. So why is the street enthused on ACC and Ambuja Cements? The new promoter has taken over. Now the street says the sleeping giant. Last few years, the capacity expansion has been very, very slow. They're saying now both these two are going to add capacity aggressively. So far more aggression from the promoter entity. The second factor is on a cost per ton basis. Well, Ambuja and ACC, well, their cost per ton is higher than, say, peers like Shree as well as Ultratech, but close to around 200 rupees per ton. So will there be some bridging of that gap? And ACC and Ambuja at some point of time, even with the old promoter, the street was hoping that these entities will come together. Then you have a bigger brand value, you have bigger market share, and you have a far larger entity. So they're hoping that at some point of time that happens. Why the other cement stocks are buzzing? Well, they're hoping that there will be some consolidation. So some of these smaller names could get picked up. And if there's consolidation in the industry, that leads to better pricing and in turn profitability. So explains why ACC and Ambuja and the cement space is buzzing around. Back to you guys.
Nigel, thanks very much for that. So that's cement in focus. 120 lower on the Nifty 17,950. Mitesh is with us. Mitesh, from the last time we spoke, we're up a little bit more. What do you do now?
So, Prashant, I think trade with stock-specific biases. I think the market is now heading towards the upper end of the. I spoke about 18,050 as the possible level. I think we are getting closer to that. But you were discussing cement, and I have Dalmia Bharat as one of my recommendation. That's that's a buy if it. Sorry, I think there is one confusion. Dalmia Bharat and Biocon is the other one. I'll just cover Biocon first. Biocon is a buy. Keep a stop at about levels of 304 here and look for 302 here and look for targets of around 315 on the upside. And on the other stock, which is Dalmia Bharat, I would recommend a buy with a stop below 1700 for targets of 1850 on there.
Hi, welcome back to Trading Hour. Let's focus on our special segment now, Fin Street. Abhishek is standing by on the big wall to tell us how CV financiers are faring on the back of the upswing cycle seen in the commercial vehicle space. Abhishek.
Well, commercial vehicle sales are back to pre-COVID levels, which augurs well for CV financiers too. The total CV sales for 2 consecutive quarters have been way above the pre-COVID levels. So commercial vehicle is a segment which is seen as closely tied to the economic growth as well. The year-to-date growth in FY23 so far has been about 75.6% for the total CV sales, about 108.2% for M&S CV, that is medium and heavy commercial vehicles, and about 62.9% in light commercial vehicles. So CV sales are picking up, with May being the best month so far in the year. So growth has remained healthy in August 2022 as well. Let's focus on the positive impact that NBFCs are seeing from the pickup in this CV cycle. Net interest margin. Now, all the CV financiers have seen an uptick in their net interest margin over the last 1 year. Now, this is due to the fact that, there is pickup in the growth, decline in stress portfolio, and the shift of borrowings to banks, which has helped in reducing cost of funds to an extent. So, M&M Finance has seen the highest expansion in its net interest margin over the last 1 year. As highlighted earlier, net interest margin has seen improvement due to decline in the stress portfolio of CV financiers. The gross NPA ratio of CV financiers has improved significantly over the last 1 year. Big improvement has been seen for the likes of M&M Finance and Sundaram Finance. Talking about another stress portfolio, which is the restructured book of CV financiers, that has witnessed decline too. X of M&M Finance. Now, Shriram Transport has had one of the lowest, restructured book amongst all the CV financiers, while M&M Finance has the highest restructured book in Q1 FY23. So, amongst all the CV financiers, good sign is that there is pickup in the CV sector, which is also witnessed through disbursements that CV financiers are seeing, and that is helping in translating into AM growth as well. So, there is not much of top-up loans, which is seen. Unlike Q1 FY22, Q1 FY23 has seen healthy quarter-on-quarter AUM growth ranging anywhere between 2.85% to as high as 4.6% across CV financiers. So disbursements in Q1 FY23 is also one of the best in many years. The stabilization of asset quality and pickup in growth can also spell healthy return ratios, that is ROEs, going forward. We have seen ROEs of CV financiers remain healthy in Q1 FY23. So Q2 FY23 may be seasonal in nature, but you can expect CV financiers to report consistency in terms of healthy ROEs in the coming quarters. So in terms of outlook, CV cycle has picked up really well, which augurs well for CV financiers. With rising interest rate, net interest margin is set to expand for majority of them going ahead. The worst of asset quality and credit cost issues are behind for CV financiers. So valuations and re-rating that you have seen for CV financiers over the last 2 years are here to stay.
All right, welcome back. The market is, at the day's highest point. And this is even more incredible because, if you look at US futures, they've just now dipped into the red. US futures were holding on pretty nicely, but they've turned around. The S&P 500 futures, for example, is slightly in the red, mildly in the red. It's not the extent, but it's just the fact that incrementally the move in futures has been lower, and here we're at the day's highest point. So it just kind of talks to the general overall strength that we've been seeing for some time now. Well, let's take this conversation on markets forward. Varun Goyal of Nippon India AIF is joining us to help us do that. Varun, great to have you with us here. Thank you very much. Prashant here. Your thoughts, Varun, on the strength that we are seeing it's basically large amounts of chunky foreign money coming back day on day. What's your best sense in terms of what's leading to this? Any dominant drivers as reasons behind this? And your assessment of how corporates are doing. I'm sure your team has been meeting companies across the board, portfolio companies and otherwise. What's the overall sense? What we hear is a fair bit of optimism about earnings growth and demand recovery. Your thoughts?
Yeah, good morning, Prashant. Thanks for having me on the show. So there is no doubt that we are on a cyclical uptick as far as the economic growth is concerned. I think after several years, we are seeing robust demand coming back. I think the biggest indicator of that is coming up. If you see in the credit growth numbers, I think for the first time since 2015, and if you leave the small period in 2019, credit growth seems to be running at 15%, with even the corporate sector credit growth coming back. So if that sustains, it means that people are buying more cars, people are buying more houses. There is some incremental capex activity which is happening in the economy. Of course, one needs to keep an eye out on what's happening in the global economy, how the US interest rates play out, and more importantly, I think the most important factor for India is what happens to crude. If the crude can sustain below $90 a barrel, I think that will be a good news. So I think globally there are risk factors which are emerging, but domestically India continues to have strong economic growth, which is probably get reflected in a buoyant equity markets at this point in time.
All right. Hi, Varun. Good morning and thanks for joining us. So, you've taken us through your call on the market, but let's talk about some of these individual sectors. I see you like some of the financials, you like the auto space. These are some stocks which have already moved up quite a bit, right? Do you think there's significant upside left here?
Yeah, good morning, Pavitra. So I think financials, both large and mid cap, is something that we find really interesting. As I was mentioning, that the credit growth seems to be coming back and seems to be sustaining. Our sense is the mid cap financials, which were really beaten down since the IL&FS crisis in 2018-19, we are seeing them getting re-rated. I think there is a long way to go. There is a whole bunch of PSU banks which have underperformed for more than 10-12 years. That's where again we see a lot of banks getting re-rated from less than book value. If they go even to the book value, there is a lot of money to be made. So that's one space which clearly stands out. Second, I think select names on the auto and the capital goods side, we remain quite positive. There is definitely growth there. I think also the real estate sector continues to show a lot of strength. We are continuing to see price hikes, and we believe this should sustain, considering the fact that residential real estate prices have not really gone anywhere for the last 8-9 years. So the cyclical part of the economy clearly seems to be doing well. And if you add some mid-cap IT and chemical stocks, there again we believe growth would be much better than what is being anticipated at this point of time. So there's a lot of avenues for bottom-up stock picking, and that's what we would like to do.
Okay. Hi, Varun. Morning. So, would you be using this opportunity to be fully invested in equities right now, since you're saying that there are, so many opportunities? Because there are some alternatives to equity investing also. For example, a lot of these corporate bonds are offering very good yields. So would you be 100% in equities, or, is that an area you would look to explore also?
So good morning, Sumera. So I look after only equity part of the business, so I can comment only on equity. So I think as far as equity markets are concerned, we are looking at 10 to 15% earnings growth for FY23. So we are looking at, let's say, a 730 rupees Nifty EPS, somewhere between 800 to 850 for this year. And I think come Diwali, markets will start discounting FY24 earnings. So we're looking at somewhere between 900 to 950 rupees earnings for FY24. So overall, I think 10 to 15% earnings growth for the broader markets looks quite healthy. And that's the kind of compounding that Nifty has seen for the last 20-25 years. And we see no reason why that should change going forward.
Yeah. So at 900 rupees for FY24, the market would be at about 20 times, right? This is 24 earnings, not 23. Some of these names that you're talking about where 15-20% earnings growth, what are you willing to pay for these? Do you think, there is enough comfort valuation-wise?
So definitely, if you look at the last 10-year average market P, we are traded at 17-18 times. We are clearly above the 10-year average. So one needs to be cautious, from that point of view. That is why we believe one needs to be more selective in terms of stock pickings. Also, The global outlook seems to be getting more cloudy. I think the 15th October, what happens in China, whether they continue with the COVID suppression policy, because that's going to have a big bearing on the crude oil price. If China continues with the COVID suppression policy, hopefully crude can stabilize below 90. But if they make it normal, if the Chinese economy goes back to the growth path, we see crude going above $100 a barrel, and that should be a difficult time for India. So these are clearly some of the risk factors that one needs to be really watchful for. Selectively, the spaces that I mentioned, we continue to be buyers, and we believe it's a good time for bottom-up stock.
All right, Varun, that point is taken. We're going to leave it there today. Thank you very much for joining us and taking us through your outlook. Some of the places that Varun is sort of looking at and things that are positive are some of the financials, telecom, auto, some of the real estate stocks as well. But with that, we're going to get into a short break now. As we do that, here's a quick reminder for our viewers. It is that time of the year again. Money Control Pro's Financial Freedom offer is back and with added benefits. So you can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Welcome back. You're still tuned into Trading Hour, and let's now bring you some important corporate opinion. My colleague Abhimanyu caught up with Shashank Srivastava, the Executive Director of Maruti Suzuki India, to get a sense of what the festive season demand is looking like, what their pending bookings are, and lots more. So let's listen in to some of that chat.
We have seen a strong booking trend so far. And going forward in the festive season, I expect the festive season to be strong, provided, of course, that we are able to produce vehicles according to the underlying demand pattern. There is a lot of pending bookings at the OEMs across the industry and also at Maruti Suzuki. We have about 425,000 bookings which are pending. So I expect the season to be strong, provided we are able to produce vehicles according to the demand.
Will car makers feel a possible impact as far as price rise is concerned? Because the recent move of the government to make rear seat belts and airbags mandatory, not just for the vehicles which already have them, but also various other vehicles which may see demands of retrofitting of the same. Is the industry feeling any pressure in that regard?
So obviously safety is the most important thing for car manufacturing, and for Maruti Suzuki also we consider it as the most important thing in the vehicle. And all our vehicles meet the regulations which are there and written, which have been enacted by the government. Regarding some of the other enactment or changes and regulations which you are alluding to, clearly the global practice is that a certain time will be given for those models which are already existing, and the new models which come in actually have to come with the new regulations. Somewhat time is given for development of for the existing models to conform to the new regulation, and I would expect that to happen in India as well.
Keeping in mind the current figures of sales in the past 1 or 2 years, how do you look at your growth projections in the medium to long term?
So if you look at this year, so far April to September, we are halfway through September almost. The projection is that maybe H1 will end up with in the industry with about 2.85 to 2.9 million vehicles, and if you add the balance 6 months, probably you can add another 18-19 lakhs. So that would mean I'm talking of Jan to September, and you add another 9-10 lakhs to it. Probably we can see in the calendar year a 3.8 to 3.9 million cars, and for the financial year, which is April to March, you would probably expect a similar 3.8 to 3.9 million units.
And with that, we'll wind up on Trading Hour. Do stay tuned. Halftime report comes up next.